Hello and welcome to Gold and Silver Assets. It's Sunday, the 11th of October 2020. And we had a few viewers asking about how gold reacts to a stock market crash. And although I have covered how gold and the stock market relate to each other in my video on gold and is deflation bad for gold, however, thinking about it, I haven't specifically addressed the situation of a stock market crash. So let's do that today. First of all, we need to distinguish the difference between a crash and a bear market. When we're talking about a crash, we're talking about a sudden dramatic drop in price where selling is panicked. And there's no strict definition in terms of the magnitude when we're talking about a crash. But roughly, I'd say we're talking about more than a 10% drop in price over a period of days. In contrast, a bear market involves a prolonged decline in price with intermittent rallies in between. And the selling is not so much panicked, and it occurs over months and sometimes years even. We have had a number of crashes in the fiat era, and I'm going to focus my discussion on the fiat era. Although we have had crashes at other times, at those times the gold price has been fixed by the government, and so we can't really extract any information from that. So let's stick to the fiat era, and I've selected these 4 dates when crashes occurred. So let's go through the charts for these. Let's start with 1987, where we had a big one-day drop in price over here in October. And now here we've got a chart of the S&P 500 index shown in the bars, whereas in the orange line, that's the closing price for gold. And remember that these charts are just overlaid, and so the scales are very different. So although the direction gives us an idea, that it doesn't tell us about the magnitude of the change in price. So another way to look at it is to do a chart of percentage changes in price here. And what I've done here is to specifically look on that one day, the 19th of October, and I looked at the high of the day for both gold and the S&P and the low of the day, and looked at the percentage change. And on that day, gold dropped 2.75%, whereas the S&P 500 dropped over 20% there. So that's a 10 times difference in price change there. Let's have a look at 2008. Now this is a little bit more messy because of course that was a bear market that we had there, but there were some days where prices were crashing, and so I'm specifically looking over here at this time period where we had lots of red bars. Now that is obscured a little bit by the gold price action here as well. So let's have a look at that again on the percentage chart. And what we're looking at is this time period from here, which is the 29th of September. And I chose this because we had some quite big drops in price over a short time period. If we use this date here, which is the 10th of October as our end point, then what happened was that gold dropped just over 10%, whereas the S&P dropped 30%, so 3 times as much. But if you look at this chart, gold subsequently actually did drop afterwards as well. And so if we did use this as the end point, then actually the drops were getting closer in terms of magnitude. But then, you know, I wouldn't necessarily call this section a crash. So really, I'd only talk about this section here. Let's look at 2010, where we had a flash crash in May. And so we're looking at from here to over here. If we look at the closing prices, gold actually moved up over that time. But let's look at the percentages changes. Again, with the closing price, it actually moved up over that time. But if we looked at the peak price from here to the low of the day for gold over here, then overall gold actually only dropped 1.67%, whereas the S&P 500 dropped 11% over that time. And then we come to 2020, and again we had a crash. You could potentially split this into two crashes, I guess, but if we took the whole time, so that's from here in February to here in mid-March, then let's look at what happened to the percentage changes for that time period. So from 21st of February to the 23rd of March, gold dropped 10% overall, whereas the S&P 500 dropped 34%. So overall, what can we take away from this? Well, the first thing to note is that for all those time periods that I mentioned, the market and economic conditions would have been different at each of those times. For example, in 1987, although we had a one-day massive drop in price, that was not part of a bear market because straight after that, price just steamed upwards and continued on in a bull market from then onwards. So it was a kind of very brief anomaly. Whereas in 2008, of course, that was part of a grinding bear market there. But what we can take away from this, and that all of those crashes had in common, was that gold fell significantly less than the stocks did. Why does gold price fall when there is a stock market crash? Well, the theory is that there are lots of margin calls as prices are dropping, and so people have to sell their gold to cover those margin calls. That's the theory anyway, but I don't know for sure whether there are other factors involved in that. But it doesn't seem to be as badly affected as stocks. And part of that may be because it's seen as a safe haven. Next up, the market update. There's not a lot going on in terms of what I can add to last week's view in terms of the short-term price movements for gold and silver and the miners. So I thought I'd do something really crazy and speculate on long-term price movements in gold. Now, remember, there's a huge amount of possibilities in terms of what the gold price can do and the way it moves in the future. And so this is just one possibility of many. And I'm going to look at the most optimistic of all. And the way I'm going to look at it is, if we look at the past price action, this is gold on the monthly scale, priced in US dollars. And going back into the 90s, we saw this nice rounded pattern over here, and then price took off. And I'd previously spoken about how we could try and join the lows here to draw these curves. Now this curve looks great and it looks pretty objective and straightforward, but actually if you try drawing these curves yourself on TradingView, you'll see that actually if you tried doing it five different times, you'll actually get 5 different curvatures here, and basically a small movement down here makes a big difference up here. And so I found this quite subjective in terms of drawing it. I've also did another subjective example over here for the more recent price action. And the name of this pattern is called an ascending scallop here. And I have seen a couple of examples where you get multiple ascending scallops in a row. So what happens is you have something like this, and then you get a smaller, narrower one, and then you get a final one which is even smaller and even narrower. And so I'm going to speculate that this is something similar to what we're getting in the gold price. Of course, that doesn't mean it's going to be the case. It could be something completely different. But look, let's just work on that assumption. And if so, that's going to be a very optimistic scenario for the gold price. If that were to be the case, what things can we look at to help us work with the price action on the way up? Well, the first thing is to try and draw this curvature in a more objective way. The other thing that I do want to bring up is that the reason that it's worth trying to draw these curves is that will help us determine, the low points for these movements. And the important thing here is that straight lines aren't going to work quite as well if we're looking at the bigger price movements. Of course, if we look back here, a straight line worked pretty well over here and over here. So, we're not going to throw those away, but of course it wouldn't have helped in terms of this longer price action here. And I do remember quite a few months ago when we were back here, someone actually did say, look, straight trend line isn't going to work here in terms of determining the low. And that actually was correct, because I think at the time I joined these two and was expecting a low of around here, which of course didn't happen. It came up to here. But the problem was that I wasn't actually able to draw a reliable curve here because we had very few points to rely on. So we just had this, 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 and this. And so where the curve was out here wasn't actually very clear. And that's one of the problems here. So one other way of looking at this would be to do polynomial regression for the lows throughout this price action. Now, TradingView does have a function where you can do this. And so I thought, let's have a look at this. So what polynomial regression does is that it basically fits a curve. And this curve, I've done it so that it's the mean of the lows. So we're talking about the low price points here. And so remember, it doesn't connect the absolute lows over here to form that curve. So that's the other thing to remember. It's just the mean of the lows. So it's the lowest objective value that I could get. Another way where you could try and capture these lows over here is to include confidence intervals, but I haven't found a way of doing that on TradingView. If anyone knows, then let us all know in the comments. But that would give us a kind of 95% confidence interval. So usually you'd get a band here, and that should capture most of those lows and give us an extra curve. But as I said, I don't know how to do that on TradingView, but it can be done on statistical software packages. And so I thought I'd actually backtest this idea to see if this works in a prospective way. So this is the price action of a completely different stock. This is actually something called Zero Limited. And what I've done is I got TradingView to draw this curve. So this isn't me drawing it. And notice that I've stopped the data over here. So we're kind of at similar all-time highs. And that's kind of where we are in terms of the gold price action. Then what I did was use TradingView to extend this line so that it tells us where price is going in the future. And I wanted to know whether that line was predictive of the price action. So let's have a look at what happened. So this is the line that I drew based on that regression line that I talked about. And when I extended it, it's actually not bad, is it? It certainly shows us the trajectory of where price is going. Of course, it doesn't tell us, when this trend is going to break. This could have looked quite serious, so particularly over here. And of course, that was incorrect. It went straight up. So remember, it's not really a reliable kind of indicator in terms of exactly where the bottom of the price is going to be. So over here, you can see it actually broke below. And as I said, this was a real problem here, because at that time I would have said, oh yeah, that trend has changed, and would have been moving downwards, but that was actually incorrect. Price continued to move upwards along this trajectory. So you've got to be careful about how you use these things. It's not an exact thing, but it seems to be a useful guide in terms of roughly where price is going. And the other thing I thought I could look at the same time, because this to me looks like this ascending scallop that we've been talking about. And what about if we did a Fibonacci extension? So let's start with, I've started it here at the high. So that's the kind of left side of this kind of cup shape that we've got here. And of course, the bottom is the bottom of this rounded structure here. And if we do that, what we can see is that price poked up and then retraced, and actually retested at the 78.6% level before moving upwards. Price then moved upwards up to the 2.618 level and got knocked back pretty severely, as we saw, before coming back up again. Is this a recurring pattern that we see in other things? Well, I've seen it in a couple of other stock examples, but I wanted to see whether that's going to happen in gold. Has it happened in gold before? So let's go back to gold and go back to the price action in the 90s and early 2000s. So with TradingView, I went back and did that regression line, and here is the line that it came out with, and then I just extended the line, and this is what we came up with. So again, you can see it's not bad, but again, we've got a couple of breaks, and this one was particularly a bad break, but that was false and price went up afterwards. So one of the things to think about is that you are likely to get one bad false break of that line, and that will be followed by a big move up. Is that something that we can consistently see? And oh, the other thing is that over here, price broke, but actually price broke down quite badly, and as we know, it went to just above 1,000 over there. And if we look at the Fibonacci values for this, so again, I've used the one value as the high on the left side. And once we got above that all-time high, price got knocked back, and it got again to that 78% level before moving upwards. And again, price kind of fumbled around a bit, so this was quite a reasonable break of that line. But as price moved up, it got to the 2.6 level over here and got knocked back down again before making a further move upwards. Let's look further back though, because of course, you know, this kind of thing has happened in gold in the past as well, and we did have another ascending scallop in the 1970s. The only difference here is that this is more of a V shape. It's not really that rounded shape that we've seen recently, and so that does affect the curvature that we're getting. And so you can see that the curvature just looks a bit off. And I think it is because here we've just got a kind of pointed V-shaped rather than a nice rounded shape, and that makes it less accurate when we draw the curve. And in fact, most of the time the price action is below that curve down here, which tells me that this probably isn't particularly accurate. But in terms of what happened to the price, let's have another look. Again, once we breached that previous high over here, price got knocked back, and surprise, surprise, it hit that 78% level before moving back up again. And another knockback happened at the 1.618 extension, but nothing much happened at the 2.6 level. So it doesn't seem to be a consistent pattern that we're seeing, but these Fibonacci extensions may be useful. Certainly we would need to be cautious at these two levels. So let's go back and look at the current price action. If we look at gold on the monthly scale, this is the regression curve for the previous ascending scallop, and this is the one for the recent one. Of course, you know, this is hugely optimistic. It suggests that we're going to get some big moves upwards in a relatively short space of time. Remember that these lines are for the lows, so most of the price action will be above this level, and in fact here it moves substantially above here. And if we look at the Fibonacci extensions that we're talking about, so here I've used one as the previous high over here, and we've gone past that, and if any of what we've talked about previously does hold, that suggests a bit more of a knockback towards into this kind of mid 1700s level, I'd say. Will that happen? I don't know for sure, but you know, we've got a couple of things suggesting that may be the case, particularly because we've got a lot of support over here, so I wouldn't expect it to go below that level. And we've also got this curve here, which seems to be around that mid 1700s to 1800 level. Once we hit that, I would expect price to start moving upwards again, and I would start looking at more closely at what's going on in terms of price action and potential change in the movement's direction once we get to around the 2400s level. Maybe it's going to go up to there and get knocked back, or maybe it just steams through there. It really depends on what's going on. If it does steam through there, then the other place to watch out is around the $3,300 level. Now, of course, remember, this is all complete speculation. This could be completely wrong. So I'm not saying that this is what's going to happen. There are lots of other possibilities, and we can look at those going forwards. But I just wanted to take into account the curvature factor. I don't want to just use straight trend lines without considering this kind of movement here. All right, so I hope that didn't all sound like completely crazy talk. This is just me throwing around ideas. As I said, I don't know what's going to happen with the gold price. Nobody does. This is just one idea in a sea of many. Thanks for all the comments in all the previous videos. I really enjoy reading them, and the things I particularly enjoy are the very well-reasoned discussions that we're having over there. But I also enjoy hearing a little bit about some of you guys. It feels a little bit like I've got a few pen pals, and yeah, it's always nice to hear from all of you. That's it from me for this week. Don't forget to like and subscribe, and we'll see you next week. Bye.